Thank you for coming. Good afternoon. I appreciate it. We have Robin Rae Huntley that's going to talk with us a little bit about your taxes, how to plan your taxes, how to run your business. If you're brand new, should you be S Corp or run it through your sole proprietorship or what else? And then also in the advanced class, we're going to, or not advanced, but advanced topics about after you start making over 60,000 or more and what we can do. So thank you for being here. Before we start, Robin's going to take over and do all this, but I will chime in with a few questions or statements as we go along. And then at the end, I think you're going to have time for questions. My philosophy is, you know, when we want more money to spend, we either make more or we spend less, or we learn how to write things off. A lot of times we go through the process and we don't really think about our money too much. We just think we need to make more. Sometimes you don't make any more, you just allocate it to a different direction to get the write-off. And that's why we want Robin here to help you plan your future, because you want to make everything you can, but you also want to keep as much as possible. So without any special ado, here's Robin. Thank you.
Hi, everyone. So my name is Robin Rae Huntley. I have been down in Florida since August of 2016, when that guy just finally put the ring on my finger and moved me down here from up north. So there's no more shoveling snow. So people say, what do I do? Do you know those people that can't afford to pay their taxes? Well, I help those people pay the least amount of taxes legitimately and realize their profitability. And when I say realize their profitability, I'm driving profits back into their business and into their wallets. And that's with Profit First and cash flow. Go ahead. I am an enrolled agent. Do you know what that is? And there's 3 people in here that can't answer because I know they know. And Tammy, you're one of them. Go ahead.
You're an enrolled agent with the IRS, you mean, right?
Yes. I am licensed by the Department of the Treasury. I work for my clients. I'm federally licensed to represent my clients before the IRS. And I have my master's in taxation, and that's kind of my sweet spot. That's really what I like to do, is taxes. I don't do bookkeeping, but I will teach you how to do your own bookkeeping, or I have a full-time bookkeeper in my office. And I have little cheat notes because, you know, remembering all those numbers are tough in my head. So what is changing in the real estate? So the Social Security that you pay, Social Security tax, right? It is for people that make over $400,000. There's an additional Social Security that you're going to pay. And we're already paying extra on the Medicare over $250,000. And then we have the tax bracket for the ordinary income. That's going to be changing as well. The limiting of itemized deductions when people itemize. Now, here's a question that I love to give realtors. When someone buys a house and their taxes, they are going to be paying, I don't know, $8,000, $9,000 in their taxes. Is all of that a deduction?
No. You mean real estate taxes?
Real estate taxes, right. No, exactly correct, because you cannot deduct what is not by the millage. So that's your CDDs and your waste and your garbage. You cannot deduct that part of it. It's only what the top part on the tax form for the that's with the millage. And I get a lot of people that come in and say, oh no, my realtor told me I can deduct that. But with the Tax Cut and Job Act, which came in effect in 2018, they got rid of the limiting on the itemized deductions. And they also got rid of a lot of other things, right? That was in the 2106, the non-reimbursed expenses for employees that were W-2 that couldn't write it off on a Schedule C. But with the new administration, they're bringing that back. And it's not going to be at the 39.7%. It's going to be down at the 28%. They're going to start limiting, if it passes, right? If it passes. And then the other thing that came in with the Tax Cut and Job Act was QBI. So are you guys familiar with QBI? No. That's your Qualified Business Income Discount. So in order to put you on the same playing field as a C Corps, because you know, who was in office when the Tax Cut and Job Act came. He was for small businesses. He wanted to put you on the same playing field, so he gave you the same 20% deduction. So that's your QBI that you get. So when you have a business loss, obviously there's no QBI. But when you have business income, you will see later in the slides where the QBI comes in. And then the long-term capital gains. Now, we all like those long-term capital gains because it depends on your income if you're going to pay 0, 15, or 20%. They want to, the new administration wants to remove that, so you're going to be paying it at your ordinary income tax, which could be as high as 39.6%. And then, so the estate tax, they want to lower the amount at, what is it, $15.8 million now. They want to lower it to $3.5 million, and they want to change the estate tax from 40 to 45%. And another thing with the estate is, Ken, I'm really sorry.
That's right.
I'm really sorry, but Ken's dad died. And Ken's dad bought a house and it was $25,000. Well, it's now worth $100,000. So getting rid of the step-up basis, now Ken's going to pay capital gains on $75,000 at his tax break, right? So that's what it means when it gets rid of step-up basis. You don't get that step-up basis anymore. So these are things that the new administration is talking about implementing. So go ahead.
Okay. So for clarity, this is not in effect yet.
It's not in effect yet, but remember, who writes the laws? Who's the one that is going to implement all these? That's right, Congress, lobbyists. And I'm telling you, the realtors have a really good, especially in this area, Tampa Bay, in Washington, because let me tell you what, I've been trying for 5 years to get in to see Vern Buchanan when I go down and lobby for the IRS and tax reform. I haven't even got an interview, but he was there because the realtors go in with the cameras. And Vern was listening.
And for clarity, they could go back to 2021 or start 2022. So if it goes to 2022, we have time to help our customers this year.
Absolutely. And also the other thing is, I think I have it in here, is the 1031 exchanges. That's another one. But write your congressmen, write your representatives, tell them that you are not happy with that change, because that's who's gonna be the one to help you with that. Complaining to your tax preparer is not gonna work. Okay, so what is changing? These are the changes. The advanced child tax credit. If you're getting child tax credit and you're thinking about getting the advance, don't do it. Because right now, most of my clients that are I'm doing their taxes for, guess what pays all their taxes? The child tax credit. And if you get the advance, you're getting a big tax bill at the end of the year. The stimulus payments. Why are you asking me for the stimulus payments amount? Why? It's not taxable, I was told. That is correct. It's not. But if you did not get it, you can get it in your income tax return. Or if last year you made like a mega amount of money and in 2020 you didn't because of COVID, then you would get it in your income tax return. And you have until July 14th to file your 2020 tax return to get your stimulus payments. So no, you're not being taxed, but you're being reconciled on your tax return. And then if you itemize right now, 100% of your charitable contributions is deductible. It's not limited at all. Also this year, if you want to buy an electrical motorcycle, you get a $2,500 credit. Just saying, it's in there. The earned income tax credit, well, that's changed in the CARES Act. It used to be from 26 to 65. If you were lower income, you could get the earned income tax credit. Now it's from 19 to whenever you can get earned income tax credit, unless you are homeless or a foster child, then you can get it at age 18. So those are things that have changed. The child and dependent care, which has always been a non-refundable credit, is now refundable. And do you know what I mean by refundable and non-refundable? Okay, so non-refundable is in the top part of the tax return where you have your tax liability and then you have your non-refundable, and it will lower your income to zero. And that's it. So if you had $5,000 non-refundable and you had only $4,500 worth of liability, that's all you got, and you lost $500. Well, now it's refundable, and that comes back to you, like the earned income tax credit, the refundable part of the additional child tax credit, and what is the other one? There's another one. I don't remember, but I will. That comes back. And then the premium tax credit. So here's something, one of your clients calls you up and says, hey, Michael, me and my wife are getting divorced and I need to buy a new house. Well, if you are having insurance from the marketplace and you get it in January and you're married on December 31st when you're not married anymore, you have to pay back all the additional premium tax credit. That's how it has been. And it will probably continue after 2022, because in 21 and 22, if you get insurance from the marketplace and say you only make $25,000 and then at the end of the year you made $60,000 and you had to pay all that back, no, you don't. You don't have to pay it back for those 2 years. So those things are in effect. So now, losing the passive losses. You are renting, you have rentals, so you are now renting, and you have passive losses. And if you make over $150,000, it just keeps rolling over. But if you make under $150,000, that you can deduct only up to $25,000, and the rest just keeps carrying over. Well, they want to remove that, so then you'll only get your passive losses after you sell the property.
Not during if you own it for 12 years.
Right, not during it.
Can we ask questions, or you want time at the end?
Oh, go ahead.
So when you say it rolls over, so if you had a $30,000 loss on an income property and you claim $25,000 that year, the following year you could roll that additional $5,000 into your losses?
Yep, it will keep rolling over. And if you float from preparer to preparer, always make sure that you get your depreciation worksheet, which is going to show your depreciation. And on the Schedule E, it should show your losses that are rolling over, so those can be captured. And that's why I always ask for the last 2 years' tax returns for the people that float around. All right. So I've been asked a couple of times about the tax breaks for hiring your children. Under 18, there's no Social Security or Medicare taxes that you have to pay. And you can pay them like a low amount, $10,000, put it into, of course they have to do some work for you, right? Make them come in and file, shred papers, whatever. And you can put that money into a college fund, or they can use it for their sports or whatever. But if you are a partnership or a corporation, you do have to pay the taxes. You have to pay the Social Security. Those are an LLC or a sole proprietor, you can do it, but if you're a corporation or a partnership, you cannot. So those are the exceptions to the rules.
What if you're an LLC but filing as an S corp?
You're still an LLC. You're not officially in a corporation. You're just being taxed as one, that has really good benefits if you use it right. All right, so another way of reducing your taxes is to open up a SEP, right? Open up a self-employment plan or a simple plan, and you can put up to 25% of your income into your retirement account, and that could lower your tax liabilities. There are ages where it cuts off and you can't contribute anymore, but that will lower your liability to the IRS, and later I have some tax returns where I'll show you what it is and how much you can save on that. And then for 2021, it's up to $58,000, which was raised from $57,000, is the maximum amount that you can put in. And it has to be cash, not property. So I know that there are the IRAs that you can put property in, but the SEP plans are different than that. So real estate agent deductions, the commissions that you pay out, right? You can deduct those. And then, here, I'll move so you guys can take pictures. Or I'll email you the screen. Doesn't matter.
You give more definition on the commissions paid out, as most of the room here, we get our commissions from the brokerage. And then if we pay out a commission out of that, the brokerage handles that. It doesn't come out of our 1099 reported income. So when you're referring to the commissions paid, how does that affect us as 1099?
You gave me $100 because I referred someone to you. As a commission.
Yeah, I can't really do that. But.
Well, I mean, the commissions that are paid out to, like, if you, does it,
Referral fee?
no, I mean, does it, like, say that someone had the
team
sale, but two people, and then it was split, does it go on to each?
Everything has to be paid by the broker, to the broker.
To the broker. And then that split out evenly. Well then, but.
We don't pay commissions.
Well, some do. Well, the brokers pay commissions.
The brokers.
Right, so that would
Brokers.
be on the broker level,
Yep.
then probably, then not on your level.
But it would be.
But if you share commissions,
Like if you wrote a check to Heather, because it's a credit, I think, again, it would be on your books. It would have to show up under that, like a repair. Mm-hmm. If that answers.
It doesn't really affect the majority of the room. I just was looking for some clarification.
Yeah, it's a rarity.
Yeah.
but it's on there. It's on my sheet, so I know that I can take it. So your home office, right? The room in your house that is dedicated to your office, square foot of that against the square foot of your house, up to $1,500 can be written off. Now, those that want to do the actual expenses and depreciate your home, remember that when you go to sell it, because then you have to add back the depreciation back into your ordinary income, and then your exclusion that you get is deducted by the percentage that you used the house, the percentage of the part that you used your house. So, you know, like, if you've been in the house 2 out of 5 years, single, you sell it, you get a $250,000 exclusion. Well, not if you've used that for a home office. So I tell my clients, just use the regular home office deduction. It's up to $1,500. And then you still get your internet and other stuff that you get to write off. Desk fees, if you, what?
If you pay for office space here, can you also write off?
Oh, yeah.
your office?
Yeah, desk fees, office space, absolutely.
Multiple locations.
My boat, can I write off my boat because I work from there?
Well, let me see.
I need to ask that question.
You work from your boat. How many sales do you do on your boat? And do you, oh, okay, so you do all waterfront property? That's where your sales are?
I'm trying.
Okay, but are they? I'm not saying trying, are they?
Only 3.
Only 3 out of how many?
28?
That's not a majority.
No. So once it
Is there a bathroom on your boat?
There is.
Oh, this is second home. You can write off the interest.
Okay, good to know. Thanks.
Your education and training that you pay for, you can write that off. Marketing and advertising, I know a lot of people use Facebook ads and stuff for their homes. That's deductible. So your standard auto expense, your mileage and stuff like that, when you're recording your mileage, I suggest using MileIQ. Out of the 4 audits I've had to do with MileIQ, they've never disputed my mileage. The person got it. So Mileage IQ, I would highly suggest getting it. And I would use your standard deduction. But if you want to use the actual, you can. And that just raises your diff score a little bit, not much. And then you just got to make sure that you keep all records, all your fuel, all your oil changes. You have to keep all those receipts for 6 years in case you get audited. When you have your standard and you're just using your mileage, then you get your mileage plus your tolls and parking, and that includes all your depreciation and everything in there. So, and that with the mileage log, with the MileIQ, you just always have it, right? Because it's just, you're emailed and you can always log in and get the stuff.
Is it relevant to gas vehicles or electric as well?
For gas or electric?
Is it relevant to electric vehicles as well?
You know, I was searching that, and it does cost you money to charge it when you, right. So it's still the same. But I was asked that a couple of years ago, or not, yeah, it was like 2 years ago. And I did some research and I asked in the NAEA group, and they said it was the same. And as far as I know, it hasn't changed.
So all what I need to do to collect my receipts, or probably snapshot from the credit card, because there is no receipt, so to speak.
For the charging?
For the charging. So, okay.
Yep. And if you think that that's more than mileage, then go for it.
Because for clarity, you can either write off your repairs, the car and all that, or you write off mileage. You
Right.
can't
And once
do
you start
both.
with mileage, you're stuck with it till you're done with the vehicle.
So if
you
you have
can't
to put
you can't flip flop.
If you have to put a transmission in your vehicle every other month because it's old and batteries and tires and like that, and you only put 1,000 miles.
Can buy a new car.
And,
Can't buy a new car.
No, and then you only put 1,000 miles, it's going to be cheaper to write off all the repairs and
Right.
maintenance as opposed to the 1,000 miles. If you put 40,000 miles and you're getting paid 50 cents a mile, that's 20 grand or 25
Right.
grand.
And there's like last year there was some realtors that came to me. They had normal miles, the normal mileage that they always use. And then I had some that didn't have hardly any miles because they said they did everything from home. They just, and I don't know. I'm not a realtor, but I just kind of thought that was odd. Like, because I know some that were going out doing virtual, you know, the virtual showing of the homes. But I just had like 2 people that said they did everything from home. I just felt that was odd.
So if you're new at taxes, in my opinion, is you keep both your receipts for repairs, cost, all that, and you keep your mileage, and then Robin can tell you which one's better for you at the end of the year, and you'll have both records and you do one or the other.
Right. But once you start with it, you can't flip flop. It's one or the other that moving forward. And then your office supplies and equipments that you use, all of that is a deduction. And, can I deduct my Apple Watch? Of course you can, because you're not being rude to your clients when you go like this, in which I don't have my watch on because I was charging it last night. But when you go like this, opposed to whipping out your phone, because I kind of think that's rude, right? When you whip out your phone. But to go like that and just see that it's nothing and slide it, I use it and I will deduct the Apple Watch all day long. So, but if you want to come in, you just got a new Louis Vuitton bag, it's $2,000. I want to write that off. I'm going to be like, no. So you have that. For 21 and 22 to help the restaurants, any restaurant purchases is not 50% for meals, it's 100%. So go out there and support your restaurants, tip your waitresses. Be kind to them because they are understaffed because they're having problems getting workers. But really, get out there to the restaurants.
Is this included in your write-off?
Absolutely. Did you tip the person?
Yes.
It was money out of your pocket. I take it.
But they have to be, they have to be related to the business.
Exactly. I mean, I'm not gonna write off the meal I just had with my husband where we just and kids, but I mean, if I'm going out to a business meal and I'm going out networking where everything was normally 50-50, it was 50%, then that's 100%. Do you know the difference between, except for Tammy, meals and entertainment and business meetings? Meals and entertainment, you're out there schmoozing, trying to get business. Business meeting, you just got done showing 4 or 5 houses and you stopped and you bought lunch and you're going over and you're writing up your proposal. That's a business meeting. Meals and entertainment, business meeting, 50%, 100%. So after 21, 22, when you go out and do that, remember that you have the business meetings that are 100% write-off. And those, you got the business, you're writing up the contract and all that stuff. Meals and entertainment, you're schmoozing, you're networking, you're trying to get people to come to you. Because I heard there's 1 out of 4 realtors in the state of Florida. So I know you got to get out there and network a lot. And then your license fees, memberships, and insurance. Do you guys all have E&O insurance, or is that under you?
No, you know.
Everybody has their own?
Yeah.
Okay. So yes, make sure that you have your E&O insurance. It's errors and omissions, so in case anything happens and you get sued, they can't come after you, they'll go after the E&O insurance. Your software and business tools that you guys use, do you guys have like a CRM that, is it through Keller Williams or?
It's either. They can buy their own or they can use Keller Williams.
Yeah, well, so those. And gifts, you buy gifts for your clients when they get into their new house. What is the limitation on gifts? $25. $25 plus delivery. So if you spent $50 on that bottle of wine, congrats, you only got $25 as a deduction. And that needs to change. So here's a tax return. This person they made $110,000 last year. They gave me their mileage, it came up to $13,504. And I just made this up, but this is numbers that I don't like. They're round numbers. And I will tell someone when they give me their numbers, that's a round number. You didn't pay tax on that? Because I don't like round numbers, but I did it this way because it was easy. So your office expenses, how much you paid someone to prepare your taxes or other professional fees, like you had a photographer or something. Your rent, that's going to go over here under your other business. And then your other expenses on the back, which is your MLS and your GTAR and all the other expenses. And then here's your home office expense. So your income now is $77,000. Now, if I was to set up a SEP with that, $17,000, then the 25% of that is $19,250. And that would lower my SE tax from, go ahead.
Go ahead, I wasn't sure.
From $10,880 to $8,163. So here's the top line. That's, your spouse who's still working, has a W-2. Your $77,000 that you made from real estate. And then you get to deduct 1/2 of your Social Security tax. So this is your taxable income. And then you get your standard deduction. And this $14,312, that is your QBI. That's your qualified business income discount or deduction. So now your taxable income is $71,000. So this is your income tax. That's the income tax that you pay. But because you're on a Schedule C and you're self-employed, you have to pay self-employment tax. So it's 2 separate taxes on the same return. And your total tax would be $22,406. Now, if this was my client, they're at that sweet spot where I can, go ahead.
Oh.
I can offer them, or do you think you're going to keep making that money? Yeah? Okay, then let's flip you over to an S Corp. Now, this is for an S Corp, and I would not do it unless you're advantageous. I have people that come in that they're only making $12,000, and they're an S Corp because someone said, oh, you got to be an S Corp. No, you don't. It costs you about $1,000 to have an S Corp because with an S Corp, you have to have payroll taxes, payroll processing. You have to pay for the S Corp return, right? So all in all, with everything, it's about $1,000. I would never do that to someone starting up when they're not making that much money and it's not advantageous to them. So now, I like to have line 7 and line 21, which if you add them up, it should be around 77,000. And then I like this at 45 and this at 55% because this one's still going to give me my QBI discount, right? And as long as you're around 50-50, that's a fair assessment. And then, so 35 is what you're going to be paying your self-employment tax on. That's what you're going to be paying your 15.3%, 6.2 for the for yourself, and then 6.2 for the employer because you have to pay for both of them. And then the Medicare is 1.45 each. So then you have your other salaries because that's your assistant and your rent and your advertising, and then on the other side is the GTAR. So then you're going to have your wages, which is going to have federal income withholding, right? And then the 43 is going to flow over as your income, but that's dividends. So you're not paying the self-employment tax on the 43%. So that is saving you $6,579 in taxes. So if I tell you, you know, I can save you $6,579, but that's going to cost you $1,000 to do it. Would you do it? So those are things, and I make sure that it's advantageous to my client before I will do that and suggest it to them. Mm-hmm.
What about a 401k where the LLC or you pay through the escrow? Would that be an advantage to lower your?
Yeah, single member 401ks are, but I will suggest a self-employment plan or a simple plan because 401k single members are higher, the fees to run it, than the SEP or the simple. And the SEP and the simple, they take the fees out of what's being earned inside. So as long as you have someone that's good with the money and it's making you money, you don't really see the fees. But your 401k, you have to write the check for those fees.
Can a SEP or a simple, can that have anything to do with a real estate investment, like a self-directed IRA?
For the deductions, no. It has to be cash. So putting real estate into the IRA, that's not going to be considered a SEP or a simple.
Are you asking, like, there's a self-directed 401 that we have to go through like Avanta, and then you now can buy real estate with the money that's in my 401?
Oh, yeah, as long as you're putting cash in it, yes.
That's your question, or did I miss?
I think so. I just have a investment guy that keeps bugging me to do a self-directed IRA to buy properties with.
Yeah, that is to me it's fantastic because it's tax deferred. You don't do anything with it, and you buy whatever you want, and then let it grow.
Administered by like Advanta or.
It has to be third party, just like your 401 that you have with Verizon. You can't touch that money.
40, not 401. It's 40.
Huh?
It's 40, not 401. It's a joke that it's smaller than it used to be.
Oh. All right, no, but basically you're not allowed to touch the money. That's why when you do a 40, but you can't touch the money and you have to invest it within so many days because then they think you're jerking the money out, to answer that question. So that's why you have to have a third party so the money never hits your account.
And then if you're having it as a rental and everything in there, you're not going to use it for anything personal. So the rent goes to the IRA, the bills are paid through the IRA and everything.
Everything has to go through that.
Yes.
And then explain to me the tax advantage of doing that, because you can, like if your income property operates at a modest profit, a couple $1,000s a year, what's the advantage of running it through the self-directed with an overseer like Advanta, as opposed to it's just an investment property that I own and I report it on
the Schedule E, go ahead.
I mean, let's say you worked at a company and you had a 401 and you quit the company and now you just have it sitting there. If you give it to a Vanta or a company like that, now you can go and invest it in whatever.
So you're rolling it out of an existing investment.
Yeah, and now you can go buy a home or loan the money out and make a lot more money, tax-free, interest growing. So if I wanted to loan the money to, Tammy has a 401 and she loans me the money, I invest it, buy something, and roll it back in there. So now she's making money, or whatever you want to do like that. It's a huge savings, big savings. And it's growing a lot faster than if you just left it in a stock or you're just sitting there making only 5%. In fact, if I can put you on the spot, you've done one.
I have a self-directed IRA, and I could tell you that. But the advantage really would be if you have a Roth IRA, because then what happens is that all the profit that you make is not taxable.
If you leave it in there for at least 5 years.
Yeah. And here's the thing, we're talking only an hour. This stuff, every topic she's hit, you could take this thing an hour in each direction on every topic. What she is thankfully doing is bringing up things that you would want to bring up to her or your accountant, whoever you're working with, and say, this is what I'm thinking, this is what I want to do, how can I get there? It's everybody has their own way of getting where they want to be. Like if it's an IRA, if it's a Roth IRA, if it's a 401, if it's a SEP. So realize that this is very big open topic. This is just to get you to think on what you can do, like writing off a boat, or how do you write off the boat, or name your boat appointment so you're on an appointment all the time, right? So whatever it may be, just open your eyes. This is something that you really want to think about and gather. So I don't mean to interrupt, but just realize
no,
this
that's
is
fine.
huge. This is huge.
Yeah, but I did realize before you get to the screen, I did miss one thing,
Sure.
and it's, I want you to go back to the real estate deductions.
Which page?
Yep, keep going. Right there. Wait, what? Wait, you didn't mention that I can write off my hair, nails, clothing, or car payments? No, you can't. I did put that there as special because I get that a lot. No, if you want to write off your clothes, make sure your name is on that, right? Like that shirt, you can write that off. But the other clothes and stuff and massages and all that, oh my God, you wouldn't believe some of the stuff people tell me, can I write that off? And I'm like, no, but I wish I could. So anyways, now you can go. I just remembered that I put that in there, all kind of cute too. So again, what do? I said that I help my clients pay the least amount of taxes legitimately, right? So I will tell you the proper deductions, what you can and you can't use, and I won't let you use the ones that you cannot use because I don't want you to raise your DIF score, right? And I know
what DIF score is, but others that
Yeah.
Can you explain it?
Okay, so I saw your hand raised or question when I said it before. So when you do your Schedule C or your S Corp, you have a 5-digit NAS code on there which says what field, what profession you're in. So the IRS has this computer system, and that when you put that return in, it's compared to all the returns across the whole United States. So if you have an expense that's a lot higher than someone else's expenses for the same one, it raises your DIF score, which means your DIF score goes up so much, you're going to get audited. So when you have a Schedule C and you don't use the front of the Schedule C and you put everything on the back, oh yeah, you can expect this. Yeah, you're going to get a letter, pretty much.
What about if it's your first year, you started in November, December, you have all the expenses, you have no income, so that would qualify?
Yeah, you can write, you can do your a Schedule C with that, absolutely. But I would suggest putting it in as amortization as startup cost. So then that way you could use your deductions in the next year to write off when you are making income instead of the write off on the first year. Because I always try to tax plan going forward of what you can and cannot do. And then when I said that I help my clients pay their taxes, and that's with cash flow and profit first. So I don't know if you have heard of Profit First, but Profit First is written by Mike Michalowicz. I am a Profit First professional. So I help my clients set up their accounts in Profit First and coach them. So you have to open up more bank accounts. You have 5 accounts. You have your income, which all your money goes into your income account. And then you pick 2 days a week. I like the 10th and the 25th because when I pay my bills on the 10th, that's the bills that are due in the middle of the month. When I pay my bills on the 25th, those are the ones that are due on the 1st of the month. So I put all my money into the income account on the 10th and the 25th. I transfer the money over to income, tax, profit, and payroll. So, and then there's certain percentages after I do a profit analysis, the money goes in there because a lot of people do bank balance accounting. They look at your one bank account and they don't think of things down the road like taxes. So if you're transferring your money over there and putting it away like the envelope system that maybe some of your parents or grandparents used to use, then when that money's not into the account, they don't think of it, it's not there. And when it comes time for taxes, the money is there. And then out of the operating account, that's the only account that you use to pay your bills. So when you're doing the bank balance accounting, that's all you're looking at is the balance in the operating account.